Making profit is considered sometimes to be a dirty word. It's not. In business, if you're not making profit, you might as well not be doing it. If you charge properly and someone goes, oh, I can't afford that, well, fine. There's plenty of other people who can afford it, and they will buy and they will pay the right rate because they want a good professional job. And your whole credibility will go forward, and you'll get referred and you'll get referred and you'll get referred and you'll get good business. It's not as difficult as it sounds to get in control of this. And a simple thing like...
This is the FieldRocket Podcast. I'm your host, Tulloch Priest, and today we're joined by Doug Diaubrey. Doug is a business coach who specializes in helping business owners achieve their goals. Welcome to the show.
Hi, Tulloch. Thanks for having me again.
Yeah, this isn't the first time Doug has been on the coming onto the podcast. In previous episodes, we've spoken about business goals versus personal goals, pricing, and more. But in today's episode, it's going to be all about managing and organizing your business finances. In a sentence or two, why should people care about this conversation, Doug?
Well, in essence, the business finances is the only reason we do what we do. Yes, you can really love what you do, and it can be a hobby that's been turned into a business and absolutely love what you're doing. But in the end of the day, if you're not generating income, the business doesn't have a standing as a business. It might be a hobby, but then you're going to have income from some other source in order to be able to live and cover your bills and all the rest of it. So if you're running a business, that business needs to be able to, A, sustain itself and generate enough money to pay its bills, pay anyone that's working for you, whether they're subcontracted or employed. And also it needs to generate enough money for you to earn what you need to live. So whether you're paying rent or mortgage, running a car, whatever it is you're doing in life, you need money to do that. Unfortunately, that's the way the world works. So if you're not looking after your finances, and if you're not going to handle on your finances when running your business, it makes life very difficult and quite stressful.
I can imagine. Where does it? Where do you kind of see people go off track, like tradespeople go off track?
The easiest way to go off track when it comes down to your finances is to assume that the accountant is going to look after it for you. The accountant is there, a very important person in your business. He's going to help you to manage your taxes and make sure that you are maximizing any tax allowances you've got and so on. But they can only give you the history of what you've done. And normally that's going to come months after you've done it. So if your accountant is looking at your finances at the end of the year, it normally takes them 3 or 4 months to go through that. It can take another couple of months to get it finalized. 6-7 months after the end of the year, you're getting the information from the accountant as to how well you did for the year. And if you didn't do very well, there's nothing you can do about it.
It's kind of like 20 months late. And then if you were going off track, you could have run out of cash already.
And sadly, that happens too often because you're not managing it. So it's, the mistake is expecting that the accountant or the bookkeeper, if you've got a bookkeeper, is the one in charge of your finances. They're not. They'll give you information, but you're actually the one in charge. You're the one has the responsibility of managing the finances in the business.
So how would you actually define the roles? Like, what is the actual role of the accountant? Is it purely that tax kind of element of it and making sure you're legal? And I'm guessing there's a separate role, the business owner role.
Yeah, I mean, if you want to be completely brutal about it, the only reason you have an accountant is because the government want your tax, because you have to submit your finances. Whether you're a sole trader, you submit those as a sole trader, but you still have to submit them in terms of what your earnings are, or you submit them as a limited company. And the reason you're submitting them is so that the government can identify if that's how much profit you've made, then that's how much you need to give to us as a percentage. If you didn't have to pay the government anything, you wouldn't need an accountant in real terms. That's what the accountant's there for. But he's there on your behalf, and therefore he's going to help you to make sure you take all the tax breaks that you can get. So whatever the legislation is, whatever the situation is that you're dealing with, they will say, well, if you do that, you can have this much deduction off your tax, and this you can claim that off of expenses, therefore you don't pay taxes on it. So they will help you to identify all the things you can do that will reduce or mitigate the amount of tax that you need to pay. So they're absolutely vital in terms of businesses going forward, because that's what the law is all about.
And for the business owner, it's like how, okay, so if the role is for the business owner is to be checking the cash flow, whatever, how do you actually start and how do you actually do that?
So the business owner is responsible for ultimately making sure that the business is profitable and is sustainable over time. So whether he's a sole trader or whether he's a limited company, it doesn't matter. Their primary responsibility is to make sure the business succeeds and there is success. And in order to succeed, you have to be making profit. Now, that doesn't mean you have to go to becoming a multi-billion-dollar business. You can be very successful as a small business, but if you're not overseeing the finances of it, you're not going to be able to be successful, really.
Hi, producer Alex here, wondering if you knew that you aren't subscribed to the channel. Well, specifically, 93% of you are not subscribed, and we really appreciate you tuning in right now, but you're missing out on even more interesting content. You're already this far into the episode, so why not subscribe to the FieldRocket YouTube channel? Because showing your support genuinely makes a difference. It's free, takes a second to click, and helps us continue to make the content that you want to listen to. Speaking of, let's get back to it.
And how do you actually, it sounds like a really simple question, like how do you actually know that you're making profit? Because there's a few kind of things in there that makes it more complex than, just a straightforward, okay, I made profit this month.
Yeah, I you're talking to business owners and you ask the question, are you profitable? Are you making profit? They go, well, yeah, I know that, I've got money in the bank. It doesn't necessarily mean you're profitable.
What's the difference between money in the bank and being profitable then?
Right. Okay. So the first thing is you need to be able to understand what your income is. So you're invoicing, you're billing, you're charging. So let's say you're doing an extension project and it's a £65,000 extension project. You're going to be charging the £65,000 because you've quoted it. That's what you're going to end up charging. And however, you are going to have to spend money on equipment. You're going to have to spend money on materials. You're going to have to spend money on either employees or subcontractors to do the build. And at the end of it, you're going to have money left over. That's your profit in terms of that job. However, out of that profit, you've then got to pay your insurances and you've got to pay all your other costs that are not necessarily associated to that project. So your marketing, your accountant, your insurances, all of these things that are not specifically that job that you're working on still need to be paid for. So those are your overheads. So you have to take, first of all, what you're going to generate in the way of income. What is the cost of sale, which is all the stuff that it's going to cost you in terms of materials and wages for the individuals working on it, if they're subcontractors. And then you've got to take out all your overheads, and then what's left is your net profit. So that's what you've really got to be interested in. Now, you can raise invoices. If you haven't been paid on paper, you can be profitable. But the reality is you're not profitable in terms of cash flow. So you've got the difference between your standard accounts and your cash flow.
Okay, so you might have completed the job, so 65K, and then the customer hasn't paid just yet. And you've had all of that materials, labor, whatever's already come out of your bank account.
Yeah, you've had to pay your subcontractors, you've had to buy the necessary material, you've had to pay for the concrete truck to come in and lay the concrete. All of the stuff that's needed to be done to build that extension has had to go out in terms of income, as in terms of cash, but you've not had the cash in. So you may look on paper, we've got £65,000 we've invoiced, but we've spent all this money, but the cash isn't in the bank, which means that on paper you're profitable, but from a cash flow point of view, you're not profitable. And I think most people understand that bit of it because it's about what's in the bank and what's not in the bank. The difficulty comes when you're paid up front and you see that you've got £65,000 in the bank, and you think, oh, great, I've got £65,000 in the bank, but 40,000 of that's got to be paid back out again. So that doesn't mean you're £65,000 profitable. You need to understand how much of that is actually yours and able to be spent because it's not required elsewhere.
So when you think about like profitable, are you profitable? How do you kind of like put those two viewpoints? Like you've got the paper profitable and then you've got the cash flow.
Right, and they are two different things, and they get mixed up quite easily if you don't understand those differences. And again, it comes back to if you're working off of what's in the bank, that what's in the bank might not be yours. That might be something that you've already been allocated. You've got to pay out because the bills are coming in, and that money is already spent. In fact, there's more bills than what you've got in the bank. So you might have 60,000 in the bank, but you've got £80,000 worth of bills to pay. You're definitely not profitable from that point of view.
Okay, but, so you need both of them to be profitable.
Yeah, you've got to, and you've got to have the ability to see what's going on.
Sorry to interrupt. Would it be fair to say, instead of calling it profitable, would it be better to say you have a viable business if you have the cash flow and you're profitable on paper?
Oh, right. Okay. So a viable business is something that you've got to then take a look at slightly differently. You can have cash coming in. You can have your basic accounts showing profitability. It's viable if it's got legs, if it can continue, you're going to have ongoing orders and you've got regular customers, or depending on what you're doing. So if you take a gas engineer that's doing the annual checks on the boilers and the fires, and they have 800 customers that they go and see every year, and they are on a routine annual check. That's a viable business because you've got business there that's coming every year. If you're a builder and you do project after project, unless you've got projects lining up, that doesn't necessarily make it viable. So what makes a company like that, where you're doing one project after another, is your marketing and sales activity has to be in place so that you continually pick up more and new work. Then you can say you're viable because you've got an order book going into the future.
Okay, so that's over a period of time looking into the future.
Yeah.
Just to kind of go back, we were talking about profitability and overheads. How do you actually work out the overheads? Like if I buy a van and some tools, that's a one-off, quite a big expense. How do you kind of add that into your overheads? Because that money's actually gone out, and the value of that van is going down every year. How do you kind of calculate those kind of?
So those are one-off purchases that you're going to do to keep your equipment up, and depending on your industry, you might have to buy on a routine basis, buy updated equipment and so on. You should be looking at that and going, right, I've bought a van. If it's a lease contract van, you've got it for 3 years, and at the end of it, you're going to give it back and you're going to get another one. You've got a regular income, a regular expenditure, because there's a monthly fee related to that leased vehicle. If you buy it outright, it's yours. So maybe you buy a second-hand vehicle, say it's about 7 or 8 grand for that second-hand vehicle. It's a one-off hit into the accounts because you've taken it. But what you should be thinking is, this is going to last me a year. I'm going to run it into the ground over the next year, and then next year I'm going to need to buy another one. Then you should be putting money to one side ready for that purchase so that you build up the money in anticipation of needing it. So you can actually look at your business and go, what are those regular things I need to buy, and how regularly do I need to buy them, and start accruing money towards it. And again, if you're doing that, then that doesn't mean every penny in your bank is making you profitable, because you're going to have to spend it in a year's time or in 2 years' time for the next bit of machinery or the next bit of kit that you need, or the next van, as you quite rightly point out. So again, if you're just working on, I've got that money in the bank. Well, maybe you haven't got that money in the bank when it comes to needing to pay out in 9 months or a year or 2 years' time, whenever it is. So you accrue the money, and that's really good to have separate bank accounts. So if you know that you've got to accrue money to go towards your equipment when you're going to replace it, stick it into a separate account. It's a reserve account. Hopefully you can get a higher interest account. You get some extra income off of it, but it's off to one side. You know you're not spending that because it's already earmarked for something.
Would you do if you're a sole trader, and what about the tax element of it? Because if we're talking about all the money in your account is not yours, like some of that is going to be paid to tax. Would you do what's a good way to kind of keep track of it? Would you do like a separate account for the tax, or also?
So I have to be clear. I'm not an accountant. So any advice on anything I'm giving now is actually about managing the business and around the finances rather than being an accountant and giving specific tax advice. I can't give that because I'm not an accountant. But what I can tell you is the accountant would know this money is allocated to a future purchase. Therefore, they can take that into consideration when they're doing your accounts, and they can say that money is accruing for something, which means you don't pay tax on it. So if you've got a project coming up and you're gonna need it, please, I'm not an accountant. There's the accountants out there going, "What's he talking about?" You need to work with the accountant to make sure that any money that you're accruing is managed accordingly, and you've managed the tax around it.
Okay, so if you have a good accountant, they'll be able to sort that out for you.
Yeah, and I would say I was actually talking to a client of mine this morning. You can go and get an accountant that's going to charge you next to nothing because all they're going to do is add up your numbers at the end of the year and give you your paperwork. It might cost you a little bit more to get an accountant who's actually going to give you the right advice when you need it. And it does cost a little bit more, because anything you do is going to cost money. If you want the right advice and you want the best advice, you do have to pay for it.
Is there kind of like a turnover where that kind of inflection point, like where it's not actually, if your turnover is quite low, maybe all you need is just somebody to file the taxes, because any savings is quite a small percentage.
If you've got a really small business and you've got a turnover and you're doing 50,000 or something, you can probably manage it with a bookkeeper. Now, again, you would need to look at this in terms of what the legislation says. But small micro businesses don't have to have an accountant file their accounts. They can file their own accounts. But a bookkeeper can help you do that because they can still do it the same. And there's so much software out there now. And the two main ones I can refer to is Xero and QuickBooks, although Sage also now do a one for small businesses. And it works it all out for you, but you have to use it. There are a lot of businesses who take on QuickBooks or take on Xero, etc., and they do all their invoicing out of it, and they forget to put all their expenses in, and then it doesn't give you any information. You have to use it fully for it to be able to give you all the information. So if you're using software system, you don't put all the information in, you're going to get rubbish out.
Yeah, well, you do get some software like Gas Engineer software that integrates into like Sage, QuickBooks, Xero. So that puts all over your invoices over. Are you fed up with drowning in a pile of paperwork that comes with running your heating and plumbing business? Gas Engineer software is an easy-to-use, all-in-one job management system made especially for UK heating and plumbing companies. From handling customer details to building quotes, issuing certificates and sending invoices, Gas Engineer software will help you save time, eliminate paperwork, and make running your business easy. Start a free trial by clicking in the link in the bio. I'm also not an expert on them, but I believe that Xero, you can import your bank statements, and then you can actually put some of your expenses in.
But you still have to record what those expenses are. So if I get a bill from BT, for example, I have to log that bill into Xero or QuickBooks. And then when it's paid out of the bank, I can marry that up. It's called reconciliation. That's what bookkeepers do. Bookkeepers can do that for you. It's relatively cheap compared to what you can earn by going out. So I would highly recommend using bookkeepers because they will be able to keep all of that information intact. We all know that when you're out and about and you've parked up and you've bought something, the receipt sort of goes in the glove compartment or in the visor, and somehow you forget to take them out and you don't do anything with them. If you've got a bookkeeper, your bookkeeper is going to go, "Where is it? Where is it?" And they're going to demand that you bring those receipts in, and that will put some actual management into your finances. Simple stuff like that. means that you won't be spending money out of your pocket and never claiming it back through the business, because that is just a waste of tax as well.
Yeah. What about just taking a photograph of it? So you get your invoice, you get your receipt, take a photo, stick it in a folder somewhere.
There's software around that does that. Both QuickBooks and Xero have an attached app that you can get, and every time you get a receipt, you just photograph it. It drops it in, sends it to your book. Oh, technology nowadays, you know this, Tulloch. Technology nowadays makes it really simple for people to do what they need to do, but you still have to do it. You still have to have the mindset to do it, and still understand that if you don't do it, you're not going to get the best out of your business.
Yeah, well, you're going to pay more tax, and then also, you need to know if your business is making a profit or not. And it sounds like a really simple question, but each month you don't want to wait that 20 months to find that out. You need to actually know if it's going off track, make a correction now.
And it's about taking ownership for the finances. And it's not, there's a lot of people don't want to know. They just want to make sure they've got enough money, and they just want to go and build their walls or do whatever they need to do. And I'd rather someone else do that. I'm, number dyslexic or whatever, and I can't cope with it. It's not as difficult as it sounds to get in control of this. And a simple thing like a spreadsheet. Now, I say that because there's going to be some people who go, I don't know how to use spreadsheets. Oh, well, how do you do a spreadsheet? Okay, get some help with that if you need to. But a simple, even a logbook if necessary, if it's right down to basics, it's a logbook that you record all the money you bring in, and you record all the money you spend, and it tells you what you've got left. And did you actually make profit or not?
Okay, so if we put all of this information into one of the accounts packages, will it tell us if we're profitable that month or not?
Yes, there are reporting systems within all of these packages, and you can just click on it, and it will come out with all the information. This is what you invoiced. That's the money gone out. That's what you've sent invoices out for your services. This is what I've spent, because you've put all the expenditure has been logged, and it'll tell you what's left, and that's what tells you whether it's profitable. And if you're monitoring that and you're looking at it each month, so we get to we're in April at the moment, we get to the end of April. By the first week in May, we should be able to say April was profitable or it wasn't profitable based off of that. Now, what I would say is, particularly if you're doing big projects, 1 month to the next is going to be difficult, because you're going to have expenditure this month. You're not going to see an invoice coming in until next month, and so on. So if you're doing project work, I'd say you need to look at it over a quarter, because over a quarter it'll even itself out between the money coming in, money going out.
Okay, and then if we're talking about like the accounts packages, are we talking about on paper we're profitable, or how do you actually or is that the cash flow as well?
Right. So the first thing is you've got to be profitable on paper, because if you're not profitable on paper, it doesn't matter about the cash flow. You're not going to be able to collect enough money if you're not profitable. So you've got to be able to invoice more than you spend in order to be able to be profitable. Once you've got that in play, you've got to then make sure that you collect your money. So any invoice that gets issued, you've got to make sure you collect it. Now, if you're doing a project, I would highly recommend that you receive your money in stages. And it's really easy to do. Let's just go back to our house extension for 65,000. You'd be thinking about the first stage of your project. So maybe the first stage of your project is to get all the ground engineered works done, the civil engineering done. So it's your drains, it's your foundations and all that sort of stuff up to ground level. All that's going to be done. So you can have a look at that and go, well, that's going to cost me in materials. Let's just say it's going to cost £2,000. I have no idea what it's going to cost. I'm just going to use that as a figure. So you'd be saying, before we start, I need £5,000 deposit to get started. That now gives you the cash in the bank to pay for that civil engineering and to pay the wages necessary to get that done. But in your contract, you said that at each stage in the build process, you need the next tranche of money. So then you'd be going, okay, the next bit's the build. So the walls go up, etc. And you'd say, right, at this point, when that's happened, and your customer knows that once all the walls gone up, the next payment is due, and roughly how long that's going to take, and so on. You'd say, right, we want a third of the income at the next stage, because then that's going to pay for the next bit. So after the groundworks are done, you get another payment of maybe £15,000, and that then you've got the money in the bank to buy the bricks, to pay the bricklayer, to do whatever you've got to do to get those walls up. So by having stage payments, the client isn't having to pay out all of it and go, "Ooh, if I pay you all that money, you're going to run away and not do anything," because we've heard all those stories before. So by doing that, they only pay in stages, and that way they can see it's going up and they're paying for the next bit. And then when you get to the end of it and it's all done, there's maybe a 5% final payment when the client is happy. It also means you're not putting at risk your business in total in terms of the cash flow. You're getting that cash coming in as you do your project.
Yeah, and then obviously you've got, a much less risk once you finish the project. They're, about the actual final payment.
And if they've been paying on time and there's been no issues all the way along, then you're likely to get your final payment without any problem, But if you get to the first bit and you say your next payment's due and they don't pay you, you don't do any more. Because if you do more, you're going to be spending money and not necessarily getting it back. So you can manage it. But provided you've put the agreement in place and you've been open with your customer, don't be afraid of talking money to the customer. They know they're going to pay for it. They might want to haggle the price, but that's a different issue. But have that agreement in place so that they know they've got to pay each way, so that your cash flow is not subject to huge hit before you get your money in.
Yeah, no, that makes sense. Just kind of going back a little bit about the overheads. So as part of the overheads, what would you kind of recommend, like what percentage of money would you actually put away for a rainy day?
Right. So the first thing to understand is, what is your break even as a business? Because every business has got its own break even. And this break even is, what does it cost you to run the business if you didn't have any projects on the go?
Okay, there's no costs directly related to whatever you were doing.
Yeah. So if you were employing a bookkeeper and it was costing you £120 a month for the bookkeeper, that £120 doesn't relate to any other business. So if you had no jobs coming in at all, you'd still have to pay the £120. You have insurance to pay and you're paying whatever it is, £75 a month for your insurance. That has to come out every month, regardless of whether you've got any work on the go. So these are the things, these are the individual things, these are your overheads that you have to pay whether or not you've got any work in. So you have to understand how much that is. And that includes any wages, national insurance contributions, insurances, telephone, internet, all of these things that have nothing to do with a particular job. You add all of that up and you then know, right, I've got to generate £3,500 every month just to cover my overheads. Then what you need to do is say, how much do I need in the way of a salary? So you can actually do that whole project the same way in your own household. So you can go, what is it going to cost me? What's my rent? What's my mortgage? What's my TV license? House insurance, car costs, food, clothing, holidays, all of the stuff that's going to you want in your home and in your life. And you go, well, actually, I need £3,500 to live. Yeah. So if you as a business owner need £3,500 out of the business and it costs you £3,500 to run the business, you need to be generating £7,000 of net profit, which is after all the expenses are taken out for the job you're doing on a monthly basis. So that's your break even. You're not making any profit at that point. You're just covering all the costs of running the business.
And that's pre-tax as well, or sorry, post-tax.
Yes. So all that comes out. Anything made over and above that is going to be then is going to be profit, and that will then be taxed at 21% nowadays, or depending on how much profit you're making. That varies slightly. Again, talk to the accountant; they'll know the exact figures on those. But understand what it costs you to run your business. That's your break even. Don't forget you are part of that, and you have to understand how much you want out of the business. So add that to it, that's your total break even for the business. Now, you've got to be generating that before you start putting money to a side.
Okay, so in this scenario, we need to get $7,000 a month. We break even, and then you would put on top of that, like if you're kind of working out like what should you charge, like what kind of profit margin would you suggest kind of putting on top?
Right. Okay. So now you're talking about costing a job out. And costing a job out, what you need to be doing is you need to be having a look at all of the costs that you're going to be engaged in terms of that job. So the material, et cetera, et cetera. If you're buying material or if the client buying the material and having it available to you, whichever way you're working it. But you've still got to make sure you understand what all the material costs are, what it's going to cost you for the subcontractors and so on. Now, you need to be anyone who's subcontracting to you, ideally, and this is only a rule of thumb, you should be looking at if it's going to cost me £100 for the day to have someone come in, and that's very cheap actually. If it's going to cost me 150 for a plasterer to come in and do the plastering, and I'm going to need him for 2 or 3 days, you'd be working that out. But what you're charging is you're charging 3 times the cost of the individual salary or subcontracted fee. And the reason for that is you've got to cover their cost. You've then got to cover your overheads, or you've got to contribute towards your overheads. And then you've got to make profit. There is no point in doubling it and going, okay, it's going to cost me 150. I'm going to charge him out at 300, because all you're doing is you're covering enough to cover your overheads, and there's no profit left.
Okay, because so 3 times is quite a lot more than you would expect.
Yes, but if you don't do the 3 times, you end up not making any profit. Now, the more you do, then of course your overheads are becoming more and more covered, because that third that's allocated to the overheads is once your overheads are covered, they're covered, and it then starts dropping into profit. But I say it's a rule of thumb. Don't get completely fixated on it. But if you can manage that, it works. Yeah. I was working with a guy who did kitchen fitting. So people who buy new kitchens, he'd be doing all the fitting. So you've got to do the tiling and the plastering and all the rest of it. And we had that scenario whereby his plasterer would charge him 150 a day, and he was charging him out at 300 a day. We went through this, and I said, you should be charging him out at 450. And he's like, oh, nobody's going to pay that. You haven't asked. You haven't built that in. If you build it in, see what happens. And he went, okay, I'll try. And he started building it in, and no one had any issue with it. And suddenly he was making profit from the time that the plasterer was in doing the plastering work.
Well, you say he's making profit, but there are some costs in there. As in, it's good that he's making profit, but he had to find that plasterer. If the plasterer doesn't turn up, he needs to cover it. Yep. It's not just...
So that's the third that is in the overheads.
Okay, that's the overhead third.
Yeah, that's the overhead third. Managing the person, making sure everything is sorted out, making sure that their invoices are paid and receiving their invoices, getting the payments done, the time spent on that is the third, which is your overhead. Okay. And then you've got your profit. Now, if you don't put that extra third on, you're going to spend that, if you double it, you're going to spend that second half covering the cost of it, bringing him in, covering his invoices, and you make no profit. Well, then there's no point in doing it. You might as well just sit there and not do anything, because you're not making profit.
Yeah, you're better off sitting on the sofa.
Exactly. Making profit is considered sometimes to be a dirty word. It's not. In business, if you're not making profit, you might as well not be doing it.
Just a kind of question, like when you've worked out your overheads for your business, excluding whatever the project costs, and all of that kind of thing, like what percentage of profit margin would you put on to charge your time? Like, let's say you're a sole trader, you're going to do a project, you've worked out that it's going to take you 2 days. Like, how do you work out what your daily rate is? Because you've got your break-even point, and then how much would you actually add on top of that to ensure that you get the profit?
If you're working the costing out and you include yourself as doing the work, then again, you've got to take out what's your salary. You've got to make sure that you're charging your hourly rate out according to covering your overheads and then making your profit. There's no reason why you can't allocate your own time in the same way as you would a subcontractor. So I'd have 33%. It sounds a lot, but when you break it down and you work it all out, it's actually not that much. And provided you're doing a good job, look, if you're doing a really good job, you're professional, you get the job done and the customer is happy, it's not a problem. If you're doing a bad job and you overcharge for a bad job, then you're not going to have happy customers and you're not going to have a reputation and your business isn't going to succeed. So provided you do a good job, provided you're professional what you do and you make sure the customer is happy, you won't have a problem. I think we talked about this in one of the earlier podcasts, Tulloch, and that was that if you don't do your costing right and charge properly, then you won't be making any profit on it, and your business isn't going to succeed. If you charge properly and someone goes, "Oh, I can't afford that," well, fine. There's plenty of other people who can afford it, and they will buy and they will pay the right rate because they want a good professional job, and your whole credibility will go forward, and you'll get referred and you'll get referred and you'll get referred and you'll get good business.
Yeah, because there's one pattern that you kind of see within the gas industry is that when some gas engineers, they will look at how much the company is charging their time out for their customers. They'll think, I could earn that. They go out as a sole trader and then they work for the 12 months, 18 months until they get their first tax return. And then all of these things that you've been mentioning, all of these overheads, start catching up with them. So, that bit where you mentioned about what's not in your bank account, is not profit. And then the tax comes in and you see them go back into being employed again. And you get this continual cycle. And I believe that's part of why, some of the prices for gas engineers is quite low, because you have this continual cycle.
Yes, absolutely. And again, I come back to the fact that if you price it properly so that you're making profit. Now, if you are making profit, and if you're not really making profit, you're cheap, people will buy you because they want the cheapest more often than not. So you can go out there and you can sell yourself and you can be the cheapest. You can do a bit of a survey. You can have a look around the area you are, and everyone else is charging £150 a day. So you go, great, I'll charge £100 a day and I'll get all this work. And you get inundated with work and you're busy, but you made no profit. There's no point in doing that.
You've kind of solved your marketing problem by being cheap, but you have created a much more fundamental issue.
Well, you're tired, you're irritable because you've not had any time off because everybody wants a bit of you because you're so cheap, but you're not making profit. So if you then go, okay, well, I'll charge 150 and you don't get as many clients, but the ones you do get are profitable and you're not worn out, tired, and you've got time to spend with the kids and have a holiday, etc., because you've not got inundated with customers that are not paying enough and therefore you're not making any profit. So you can be a busy fool. You can run around a busy fool and make no money because you're the cheapest on the market. Anyone can do that. It's not going to do you any good.
Yeah, and if you are trying to build up like a long-term business, like with the service reminders, if you have the customers that are always looking for the cheapest, that's not going to be, or it's possibly not as sustainable as somebody else. Like if you're charging a higher price, and the people are valuing you taking your care, making sure it's done correctly, as opposed to the price is the most important thing.
And this happens not just in the building industry and the gas industry. This happens right across the boards. I work with businesses right across the boards and regularly have this conversation around you're not charging enough. And quite often it's actually in the business owner's head. I'm not worth it. I'm not worth that much. You are. If you're doing a good job and you're doing the best job possible and you're providing a really good service, then you should be charging for it. I think that the psychologists will say it's the imposter syndrome because you don't believe you're good enough. But that doesn't help you with your business as you go forward. You've got to sort of get over that. And when you do ask for it, so many of my clients, when they've said, put your prices up because you're too cheap, and they go out there and I said, try it for me. Go and ask, try it, see what happens. And they come back and they go, nobody batted an eyelid. Yeah, because the problem with the price was it was in your head, not in the customer's head. The customer is really willing to pay for a good service. Think about your own buying. Would you go into Curry's and buy the cheapest TV that's up on the wall? Probably not. You'd probably want one that's maybe mid-range. I do know some people who would buy something that's out of this world and thousands of pounds, but most people will buy that mid-range because they don't want the cheapest, but they want something that's really good. because they want to be able to sit and watch a program and have good visuals and good sound and all the rest of it. Now, they might buy the cheap one to go in the daughter's bedroom or the son's bedroom as a little bedroom TV, but the main one in the main room is going to be there. So we don't have a problem paying for quality. We don't have a problem paying for something that's being done by a professional that is absolutely essential to our lifestyle.
Yeah, no, that's a very good point. Well, I think I can talk about this all day with you. So I really appreciate your advice and input, and really appreciate you coming onto the podcast. So thank you very much.
Yeah, no problem at all. If anyone who's listening wants more knowledge on this, I have loads and loads of blogs on my website. It's all free. You can go on there and get it, and there's plenty around this subject.
Yeah, and there'll be links to Doug's business and his all of his details in the comments. So thank you very much.
Yeah, thanks for your time.